Good afternoon. Thank you for taking the time to join me. My name is Cynthia Asen. I'm dealing representative with Integrated Equities. Today, I'm going to focus on different types of private equity real estate that you may want to consider investing in for either your registered accounts or your cash. At Integrated Equities, we work with experienced management teams. Each have a strong track record and have very specific investment strategies. We conduct independent due diligence and selection process for the third-party offerings to verify the information before we make it available to our investors. We consult with you to determine if these investments are even suitable for you. We're registered in BC, Alberta, Saskatchewan, and Ontario, which means we can act for residents in those provinces and for any companies that file in these jurisdictions. We act as agents, representing both you and the company. We facilitate the subscription process. Our real goal is to help you put private equity real estate into your financial portfolio. So as with all investments, there are assumptions and risks, and it's important that you read and understand the information. And this will be contained in the documentation, and usually it's under an offering memorandum. With every investment, they target the returns, and these are based on forward-looking statements and information that is available at the time they're prepared. Please note, past performance is no guarantee of future results. Private equity is just an alternative investment. It's not traditional. It's not like stocks, bonds, or cash. Some examples are real estate investment trusts, land development limited partnerships, mortgage investment corporations, to name a few. This allows people to invest where they may not otherwise be able to. It gives you some diversification outside of the traditional stock market ups and downs, some potential for higher returns, because generally these are getting in at a ground floor level. Good inflation hedge when you're looking at real estate, and they also can provide income stream. So you benefit really by the industry experts. So you don't need to know the industry that they're building in or the real estate market, because you're relying on that expertise. You don't have any qualification for mortgage requirements. You can use your registered accounts, RSP, TFSA, LIRA, and you can also participate in larger deals that you might not otherwise even be able to, like a commercial land development. There are some risks and there are some considerations. These are longer time horizon investments and they are illiquid. So you need to understand what those are and make sure that you can invest for the period of time that they're recommending. They are subject, because of this more economic risk, the longer the investment and the less liquidity, you're subject to the environment that we're in. So you're really relying on the management expertise. High growth companies tend to have some management issues just because they're growing quickly, and possibly in the construction side, some supply chain. And then if it is a deal that's starting and finishing, like a land development deal, there could be some exit risks, which means it might not make sense to sell the property, or if they have to sell, might adversely affect the returns. So talked about that document. There is a document called an offering memorandum. It goes through all of the risk considerations along with key assumptions and tax considerations. So common financial structures are limited partnerships or real estate investment trusts, or a mortgage investment corporation, or a mutual fund trust. So every company prepares either a limited partnership agreement or an offering memorandum. That document explains the investment, the business plan, how you're paid, is it income, capital gain, what is your time horizon, any risks, tax considerations, key assumptions are outlined. Generally our investments range from anywhere from as short as 4 months to 10 years, and generally in the 3 to 5 year range. A limited partnership is where there are two or more partners that run a business together. One is the general partner and responsible for managing the business and is personally liable for any of the debts the business takes on. The limited partners, or the investors, you're only liable for the capital that you contribute to the business. And that's usually all you do, is you just provide the equity for the business to operate. and generally restricted to an accredited investor only. I'm going to talk about qualifications later in the presentation. Real Estate Investment Trust is a vehicle that pools money from multiple investors to buy real estate assets. They're structured as trusts, and they're a special type of corporation that is required to distribute at least 90% of its taxable income to the shareholders as either distributions or dividends. The Real Estate Mutual Fund Trust is an investment that also pools money from multiple investors and generally buys a portfolio of real estate properties. It's run by external trustees and managers, and the performance of the fund can be reliant on the performance of the underlying properties. Lastly, a mortgage investment corporation, again, pools investors' monies to invest in mortgages or other mortgage-related securities. These investments are secured by mortgages. They generate income for investors through interest payments on the mortgages. So we offer a variety of different real estate asset classes operating in different geographical areas: commercial land development, purpose-built rental in Canada, US multifamily value add, Canadian multifamily REIT, and Ontario Mortgage Investment Corporation, which allows you to diversify your holdings within our group of offerings. Just to know, we don't work with startups. Each company that we represent has successfully exited multiple deals. The management team is very experienced. We've done checks, background checks. Their personal and professional references demonstrate sound reputation and integrity. They have a proven business model, excellent track records, and a disciplined approach to operating their businesses. So our target annual returns is what we look at, and currently it ranges anywhere from 7% to 20%. The less risk, generally, the lower the return, the higher risk, the higher return, generally, the greater the risk. In terms of minimum investment, it's very low. It's $25,000 and no further commitment from you. It's eligible for all of the different types of registered accounts. We don't have our, we do have RESP. So we've got RSP, TFSA, RIFs, FLIRAs, RESP. Obviously, you have to match the time horizons in these different accounts and also the objectives. So where are we at today? And let's focus on what the reason and why we would make recommendations. So my opinion is, and my thesis is, that the recession will last longer. Interest rates will go higher. And if not, they'll stay and they won't go down as quickly as everyone hopes. Preservation of capital is really top of mind for me, and I like hard assets because they're good hedges against inflation. And while inflation is showing it's cooling, the job market continues to defy these forecasts, which could put pressure back on inflation. So we anticipate one more rate hike with the US Fed. And while Canada's paused its rate hikes for now, it's not lowering its rates. A key barometer is looking at the global picture, and the International Monetary Fund lowered its global growth rate and stated uncertainty is high. It's difficult to make forecasts right now, given the environment. A recent Bloomberg survey is pegging there will be a recession at around 65%. So this just leaves investors uncertain on where to invest and what to invest in. So here's our thesis. We all know housing affordability is a problem, both in Canada and the US. Canada has high immigration targets, and the supply is just not keeping up with the demand. This is a chart that shows how house price ratio in Canada fluctuated between 2012 and 2022. House price growth has outpaced income by almost 51% since 2015. That's why everyone's younger, older, everyone's complaining they just can't afford to buy a house. And this is a recent report by Desjardins as of February 2023. Canada wants 1.5 million immigrants by 2025. This report estimates nationally housing starts would need to increase by 100,000 units from its current base of 210. And recent CMHC data shows that housing starts will hit 215,000, well below that supply that is needed. So, we look at Canada and why we like Canada, why we like real estate. Canada's double the per capita growth of the US. It has the lowest number of dwellings per capita in all of the G7. And just to get to a G7 average would require us to build another 1.8 million homes. there is approximately 24,000 units in 2022 that were delivered in Ontario and anticipated to be delivered over the next 10 years. And, there's a demand of 1,242 new rental units each quarter in the GTA. So there's a lack of housing supply. So we are real estate focused. I'm going to touch on all of the sort of key characteristics of each of the ones that we continue to offer to our clients. However, I'm going to focus more on the ones that I really like in today's environment. Centurion is one of the ones I like. It's my number one pick. It invests in a diversified portfolio of rental apartments and student housing properties, as well as mortgages and equity investments in property developments across Canada and the US. Now, they're predominantly in Canada. They are divesting of their US holdings, but as of March 2023, they had 151 properties, approximately 22,000 units, and 46 cities. Since inception, if you were to invest $100,000 and just kept reinvesting the income distributions, your $100,000 would be worth $580,000 today, almost $581,000. So, that's about a 13.1% annualized return. New Haven is a mortgage investment corporation, and it's a diversified pool of residential mortgages. New Haven manages all aspects of the mortgage financing, from loan origination and through property due diligence to funding and servicing. Their fees are paid by the borrowers. So they're residential, they're short term, generally less than 2 years. Their average loan to value on their one unit classification is about 70%. And formed in 2009, they're currently paying around 8% per annum, paid monthly, or again, you can reinvest. West Urban, we recently brought on our investment shelf. They are a real estate development company. They develop purpose-built multifamily residential. The principals of this company have extensive experience in land development construction in the past, in their past history or their past companies. I did a recent interview with both the CEO and the CFO, and I encourage everyone to listen. It gives great insight to the managers or the principals of this company. So they really, they've done 16 projects, they've exited 11. They're purpose-built multifamily, very basic, but also a good, solid, brand new. They build nice buildings. We just did a tour recently. 20+% annualized return is what they're targeting. As an investor, you would get 8% preferred return, which means that, they don't go to profit share split until you get your 8% per annum paid. And then it's a 50-50 profit share. The target investment period is very short, 18 to 24 months. And how they do this is they actually have land banked, and they've gone through all the rezoning and all. They're right at development permit when the investor's money is asked for. So the average annualized return for this company is 25% on all their 11 exits. So it's an excellent company, and we really are happy to have being able to offer it. US multifamily value add, Western Wealth Capital. This company is based in North Vancouver. It's been a really Cinderella story. It's grown very dramatically. They've acquired about $5 billion of multifamily buildings in the Sunbelt states, acquired 126 properties, exited 54 with an average annualized return of about 30%. Now, the fund that they formed invests in limited partnerships, So the target returns that they presented, I think, will be easily achieved. However, as I talked about earlier, past performance is no guarantee of future results. But it does give investors an excellent way to participate in the US multifamily. Greybrook is a land development company, and it's one of Canada's largest development companies with over $285 million in development since 2007. So they have exited over 15 developments, and the average annualized return has been around 23%. The average holding period, this is a bit longer, fits really nicely in the registered accounts, about 5 years. So Greybrook has done a number of developments in the Greater Toronto area. They are big developments, and they really partner. What Greybrook's part is, they're the equity stack, they find the money, and then they partner up with the better developers in the GTA, Tribute. They've done a number of different communities with large real estate developers. So they just really manage that process to ensure that investors are getting great returns and they're getting good reports. Nationwide is a commercial land development of self-storage and express auto wash. It's really designed to provide monthly income, plus participate in income and profits when the property is sold. This is their 6th development fund. Right now, they have not identified an asset, which means it's called a blind pool. They have a very disciplined approach. They retain the best consultants for this type of a development. And if we look at what their other developments are doing, they're doing very well. So we continue to raise money for them on the understanding that they will find that perfect asset and it will produce great results for our investors. So I'm going to drill down a little bit more on Centurion, which I introduced earlier. This company has a lot of focus on its employees, and it does get recognized in doing so, which I think is extremely important when you're running residential properties. It's a people business. So trust highlights, I think this is a bit outdated, but let's go. As of February 2023, they had 6.5 billion under management. Their annualized return is around 13%. I think it's 13.1% since 2009, which means if you took your money invested today and kept reinvesting the income and at the discounts, you would have achieved about a 13% annualized return. But if you're taking the monthly income, they pay 4% and it's paid monthly. And on the other side, it's very, very much tax advantage because not all of that income is treated as or taxed as income. There is a split between capital gain and income. So it's a good structure to minimize tax. So their properties are throughout Canada and the US. They are exiting most of their US properties so they can focus on Canada. They invest in income producing apartments and mortgage investments. They are involved in one of the most stable sectors of real estate, and that yields the most consistent returns. It's designed to be tax efficient. You can get your monthly distributions, you can reinvest them. It has great long-term growth potential. Eligible for registered accounts, and really it's real estate without the responsibility of management because they have an experienced professional management team with a very solid track record. So purpose-built rental, already built, though they're not building it. They have 151 properties, just under 22,000 rental units in 46 cities. So I'm going to talk a little bit about their debt, which is, I think, really important. Average interest rate in their debt portfolio is 2.9. Average term is 6 years. And their loan to value, which means how much equity is about 49%. So there's about 51% equity in these properties, which is substantial and also gives them a lot more buying power. They do structure their debt so it's staggered. So they're just mitigating the risk to having all their interest rates come due at one time. This is an example of a $100,000 investment again, and what it would look like if you had just kept investing and reinvesting over the last, say, 14 years. And it's not always the same return. So I like to illustrate how that works. Looking at this, it shows that the Real Estate Investment Trust has, it has ups and downs, obviously. So as they're buying throughout these markets, it really means that you can take advantage of that. I call it dollar averaging. So every year they're buying some. So even if you're buying in a higher market, you're in the fund and they start to buy in lower funds, just like we're getting into now. I think there's going to be some downward pressure on values because cap rates are going up. So some highlights from 2023, certainly it's well positioned to withstand a recession should we go into one. I mentioned that, the interest rate being low, the maturity quite long, and the low loan to value, that gives it a strong covenant. Currently, they're borrowing money at about 3.8% through CMHC financing programs. So they continue to acquire and grow and increase the net income through their stabilization of these assets. They had very strong growth in 2022, acquiring over 48 properties. So, my equation is low vacancy, rising interest rate, rising rents equals higher cash flow. So let's skip to my next favorite, which is New Haven Mortgage Income Fund, which is managed by Mortgage Investment Corporation. So investors pool your money, you invest in the New Haven Mortgage Income through a subscription process. This money is then lent out to residential owners in Ontario. And so I get the question often asked, who are these borrowers? Why wouldn't they just go to a bank? Generally speaking, they're not bad borrowers or don't have a bad profile. They can't get it from the traditional source because they don't have the credit rating that is required. They're either new to the country, recently divorced, or self-employed. Mortgage investment corporations offer more flexibility. And people like that. They may not want to have, the limited prepayment, the defeasance, the penalties. So mortgage investments have some more flexibility than this. They're generally quicker to fund, and you can negotiate more customized terms. New Haven Income Fund is managed by the Mortgage Investment Corporation, New Haven Mortgage Investment Corporation. And this is really to protect the investors with the two separate entities. Anything should happen to New Haven Mortgage Investment Corp, then your funds are in another entity, and that could be taken over by another company. The Tax Act provides for the structure that allows the funds to flow through to the investors, and your returns will be taxed as income. New Haven is really a niche mortgage player. They're short-term loans. They're either under 2 years or just 2 years, and many are interest only. They provide a full service brokerage. They cover every aspect: obtaining, placing, tracking, and originating the mortgage, and then also underwriting it. They also have a facility in the event of a default to take over the property and manage the property through their property management division, if they believe they should hold the property to realize better value at a later point, or they can sell it quickly under power of sale to cut their losses. You receive monthly distributions, either in cash or you may reinvest that. And in the event you need to liquidate, it's just a 120-day notice without any further penalty. This is the structure. New Haven Mortgage Corporation manages the mortgage process. Integrated Equities facilitates the subscription process for you, and you invest in the New Haven Mortgage Income Fund entity. So you will get the income from that fund. The management team has decades of experience in the mortgage industry. Jason Viner has been in the mortgage investment business for over 30 years. The fund has external oversight as well to make sure that the interests of the corporation are aligned with the investors. And since inception, they have never missed a monthly distribution. They've set themselves up for liquidity. They have a large credit facility for liquidity purposes. Currently, they have 35 full-time employees to handle all the different aspects of mortgage lending, including the property management side. So just to recap, review the offering memorandum. That's the document that's going to tell you what this investment's all about. Understand that this is probably the most liquid investment we have, and while your money may be waiting to do something more with, you could park it in New Haven and earn up to 8%. They have two share classes. So one is lower loan to value, and it pays less, but it's around 6%, or you can go at a higher rate at 8%, which has a little bit higher loan to value. They have management fees, about 1.5%, but all the returns are illustrated net of those fees. So these are the statistics. There's about 165 million under management. The average loan size is around 300,000. Your loan to value right now is slightly higher than this. It's about 69%, 100% Ontario mortgages. Not, their arrears, but not in default, is very low when it's compared to other mortgage investment corporations. They do have a loan loss reserve there to protect them. They have around 331 investors currently. So, you want to just kind of figure out if this works for you. do you understand all the information? What level of concentration are you comfortable with? Have you considered using your RSPs or your TFSAs? These are great options for these funds. And then do you want to reinvest? Do you want to take the cash? What does that mean from a tax point of view? And just make sure that you're aware of all of the different aspects of the investment before making that decision. It's just be informed and ask the questions. So who can invest in? How is this sold? Well, we're the facilitator of the sale. So we'll provide all the documentation. We'll explain all of the key assumptions. We'll talk about how you make money, the business plan. But really, it's covered off in 2 documents: a limited partnership agreement or an offering memorandum. So if you have questions, it's best to read these documents thoroughly. We can highlight the areas that you should read, because that'll explain how you're going to make money, when you're going to make money, how it's taxed, and that. But it's pretty straightforward. They can be sold either directly from the companies, and that's called a connected issuer. That's an internal sales force, or through an exempt market dealer like us. We're dealing representatives. So what that means is we've actually vetted the product independently with other sources, so that we know the information is valid and the assumptions made are real and the forecasts are attainable. And also portfolio managers, which are private wealth managers and work for banks generally. Everyone can invest in private equity. There are some restrictions, and I'm going to talk a little bit about the qualifications, and then also, there's suitability factors as well. So these are the most common financial qualifications. There's the permitted investor, accredited investor, eligible, and non-eligible. So permitted investment is a high net worth, and there's no requirement on our part to determine suitability, as you are considered sophisticated and capable of making financial decisions without a lot of guidance. Only thing we are required is to obtain proof that you are permitted, and that would come from either your accountant or your wealth manager or your bank manager. Accredited is another qualification of a high net worth individual, and you only have to meet one of these criteria to be considered accredited. Now, keeping in mind, if a spouse, two partners, a husband, wife, spouses are going to invest, both have to be accredited if it's a limited or if the investment is accredited only. So how that would happen is, as an individual, you have 200,000 over the past 2 years, or you have a household income of 300,000, or net financial assets, which are your cash, your stocks, your bonds, your non-registered investments, your registered investments, and even private equity is considered liquid. That total exceeds 1 million. Or your net worth, which would include those financial assets, plus your real estate, plus your business assets, any life insurance, less any liabilities. This amount would have to exceed 5 million. So these are the most common ways for people to qualify for the accredited investments only. Now, the other investments, which most on our shelf is for everyone, eligible investors. And where I talked about there are some restrictions in Alberta and Saskatchewan, Ontario, you're considered eligible if you meet one of these criteria, which is $75,000 income, $125,000 household income, or you have a net worth of more than $400,000. We would still have to collect all your information so that we understood what your net financial assets are, because there is a suitability requirement on that. So again, we have to capture all the financial information so that we can make the recommendations as governed under legislation. And then for the non-eligible, which would be someone just starting out, the restrictions are Alberta, Saskatchewan, Ontario. Oh, and BC really has no restrictions on these, but there are suitability restrictions. But Alberta, Saskatchewan, Ontario allow anyone to invest up to $10,000 per year through an exempt market dealer or direct with the company. And in BC, there are no restrictions. The only thing that is kind of different is the suitability side. If you scan this, you will get access to everything that we do. It's what I do to connect you to any educational webinars, any launch events, anything that we do. This will allow you to keep up to date on what we're doing. And then if there are any questions, certainly like to take them now.